Worldwide markets this week. Market returns so far in 2025. They tell a story, but perhaps not the one we expected after that April sell-off. I'm Simon Brown. This is Worldwide Markets, episode 637 for 2 July. I'm recording Tuesday afternoon. Worldwide Markets powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest forex rates. Remember, Shift now also doing JSE shares. So let's get to it. I suppose let's paint the picture. We came into 2025. We had load shedding largely abated. We had a 6-month-old government of national unity that was kind of hanging on more or less. If we looked more broadly to US markets, the big tech was expensive. Very expensive, like eye-wateringly expensive. To be clear, immensely profitable. They make a fortune of money, make no mistake about that, but they were also very, very expensive. And we'd already seen a little bit of selling in US equities, particularly the NASDAQ. Trump came in on the 20th of January, and immediately things got wild. Tariffs on Mexico and Canada, and then walked back a couple of days, maybe a week later. NATO under the bus, Paris under the bus, Paris Climate Accord under the bus, and kind of set the scene for what we were going to see with the second term of Donald Trump. It wasn't, I think, a massive surprise. The big deal was, of course, Liberation Day, 2nd of April. He announced tariffs, and they were giant. The market knew they were coming, but not to that level. And that saw the US 10-year yield go over 4.5%. You've got to remember, Liz Truss essentially got kicked out, resigned because of the UK 30-year gilts getting over 5%. 4.5% was a line in the sand. 9 April, Trump walked it all back, said there's a 90-day pause. That 90-day pause ends next Wednesday. However, Treasury Secretary Bessent has basically said, look, September maybe September we'll get some stuff. They've got a bit of a deal with the UK, a bit of a deal with China, and that is about it. To be clear, that is about it. So it's been an immensely volatile. And I want to start with the Rand, because we need to remember that way back in April, the Rand was at 1990 against the dollar. And that was truthfully, a spooky number. We were all sitting here thinking, where to next? As I'm recording this, Rand is below 1760 against the dollar. Massive turnaround. I know it's dollar index strength more than anything, but we can see it because if we look at year to date, the Rand is almost 7% stronger against the dollar, but against the pound, it's 2.2% weaker, and against the euro, 6% weaker. It is really, yes, some of it is our own doing, and we'll take it with both hands, but it really is a case of dollar weakness. So dollar's had one of its worst starts to a year, to 6 months start to a year, and I think the headline I saw said 50 years, almost my lifetime. The dollar matters because we are commodity producing and we export, so our miners are going to get a little bit less. Of course, it also matters because oil is priced in dollars, so petrol price, thank you. But our major trading partners and our major tourism partners is the UK and Europe. So this currency is going to hurt. But let's kick off and let's look at some commodities and let's get some year-to-date numbers. The huge one has been the platinum. We came into the year and we were bullish on gold. We'll get to gold in a minute. Platinum is trading up at 1,360 as I record this on Tuesday afternoon. It is at 10-year highs. 10-year highs on platinum. We've got to zoom out even further to really get a sense. We are sort of back to levels last seen in 2014, August 2014. That is absolutely a significant break. It is important. It is happening, and it is making the PGM miners suddenly look a whole lot happier. And if I could spell palladium, we could even have a look at a palladium price. Palladium is broken, but not to the same degree, and then it's just not looking as exciting. And in fact, I can't believe I'm seeing a palladium price of sub 900. I am fairly certain that is wrong. Let me go double check that price source. Didn't feel right by any stretch of imagination. Where are we? Yeah, I don't know what is happening with that palladium price. Anyway, okay, so ignore the palladium. It's broken. It hasn't collapsed yet to that point. But let's go back to our commodities. Gold has had a great year. It's up 27%. Now, sure, compared to platinum up 52, it's a little bit easy, but gold's been coming off a much higher base. We still see it run and then consolidate, and we have a consolidation. We saw a bit of a sell-off to 32.50. That's the spot market. That was on Monday. It rallied. It's now 33.50. So certainly moving there. The gold story remains. A report out I read earlier this morning talking about how central bankers are expecting to get to reduce new purchases of US dollars as well as US treasuries, which means a weaker dollar, not surprising, risk to the 10-year at the same time as well, also not surprising. But perhaps the bigger picture there is, well, where are they going to go? Well, they are going to go to gold. So gold story remains. Copper up nicely, 27%. Rhodium, uranium, aluminium. There's palladium, but those numbers are ugly. Iron ore is flat for the year. Brent is down 10%. Coal is down 12%. We've seen Exxaro. We've seen Thungela. It's tough out there. Coffee's down, although it's still at fairly high levels. Although I got to say, my coffee bean price hasn't come down, but it's been a good year for commodities broadly. Now, if you're in the wrong space, a little bit less so, but that wrong space is more the industrials, the precious, absolutely having a good time of it. So let's look at some of the big stocks. And let's sort on at the top of our list in terms of returns. Sibanye Stillwater, 115%. That is total return year to date. Followed by Northern Goldfields, Impala, Harmony. I mean, just no surprises by that. Then we've got Volterra, but in between sitting there, weirdly, is MTN, up 58%. I got to say, I didn't see MTN coming to the party. Look, I don't like telcos. MTN is back at a price last seen in mid-2022, so 3 years ago. Telco's never been my thing, although MTN has rallied nicely, almost doubled off those July 24 lows. So you've almost doubled your return since then. Some of the others, Vodacom's there as well. Process and Naspers up 32% each. I got to say, the new CEO, although perhaps it's not fair. So what we say is, the new CEO is doing it. He's frankly reaping what the previous CEO had done, and it's now finally coming to fruition. British American Tobacco, absolutely a surprise to see British American Tobacco there. You would think to yourself, tobacco's surely dead. Surely dead. But it is, and I'm zooming this chart, and in rands, it's sitting at record highs of 840. Tobacco is dying slowly, and they've got their non-combustible products, so fair's enough for them. Richmond up 20%. They started January with a big bang. Trading update sent them up 10% on a day. And the top 40, 17.75% excluding dividends. That is giant, absolutely giant. Capitec, the top bank up there, 14. But let's then go look at some losers. We got Aspen down 27.5%. They had that announcement, was it back in April? Yeah, I think April, maybe early May. They were losing a contract. They've got issues. And I wrote for Financial Mail at the time that part of their challenge really is going to be getting trust back in the market. That really is it. SPAR down 26, Mr. Price down 25. That's not massively surprising because we had seen a huge run in Mr. Price into the latter half of last year. And it had gone from a low of 120 up to 300. The stock's looking fine. It's not expensive. The chart is looking decent. Support at around the 200 held nicely. I hold it. I'm happy to hold. I think we've potentially got some more upside there. Where else are we? Glencore, Willie's, no surprise there. Bidvest, Nedbank, that does surprise. Kumba, not a surprise. Sasol's only down 5%. Wow. Would have thought Sasol was having a way worse time. Shoprite off 5%. I mean, think of Sasol, think of Shoprite. You think of Sasol, you think, it has been an absolute horror show. And then all of a sudden you realize, well, actually, it is a horror show, but not maybe that bad at the end of the day. And that's, I suppose, often how it goes is that, yeah, it's a horror show, but it's all relative. And what we've seen with Sasol, perhaps more than anything, is just good old-fashioned volatility that has been creating the chaos more than what we would otherwise think. Because to essentially be matching with ShopRite is quite the story there, I would say. I did not expect that in the very leastest. We've got an event coming up, 21 July. It is a power hour. Importantly, it is a Monday. We try to do these on a Thursday, but sometimes venues, Standard Bank is fixing up their venue. What we're looking at is I've been in markets for 3+ decades, and I have learnt the scars. There's a quote here from Oscar Wilde: "Experience is simply the name we give our mistakes." I've made those mistakes. And what I'm going to be going through is what is 30 years of, well, I was going to say my lessons. I suppose it is my mistakes. I'm going to go through sort of, understanding what I've learned over the process, where I've gotten smarter, and truthfully, where I still perhaps struggle. JustOneLap.com/events to attend live or the webcast. So let's get back to markets a bit and let's pick up. I'm going to do ETFs on their own in an ETF post next week. Sorry, not next week, tomorrow, rather. But let's have a look, because it's been, there's movements all over the place. It's not just local. So US markets. The Nasdaq there it is, composites up 5%. The S&P is up 5.5%. Canada up 8.5%. That is a surprise in many senses. I wouldn't have expected perhaps that. Yeah, they were down almost 20% back in April. But the big story, perhaps more than anything, the big story has been around Europe. France up 4.8, Germany up 20, what's that? Italy up 16, Spain 21, Switzerland 2, the FTSE up almost 8%, Netherlands up 5%. If we're seeing weaker dollar, money's leaving. Where's it going? Well, some of it's going to gold, but a bunch of it is equally so, is going into European markets. With Trump throwing NATO under the bus, Europe is suddenly like, okay, we've got to spend money. The latest talk I saw was that they're talking around the NATO summit over the weekend that they will spend 5%. Now, on defense, 3% will be direct spending. The rest will be cybersecurity, infrastructure, those sort of, they are defense, making sure that your oil pipeline is not, for example, coming from Russia. Over in Asia, Hong Kong's up 20%, Japan 1.5%, India 4.5%, Singapore 4 and a bit, Australia 3 and a bit. We are having, by we, I mean the royal we, a really, really good time of it. And I know a bunch of you are saying, but what about the market in ZAR? Well, our market in ZAR year to date is up almost 30%. We are beating the gold price. We're up 30, Nasdaq 7 and a bit, S&P 5.5. Again, it is just crazy stuff. But let's go have a quick look at yields, because that perhaps is the bigger story. As I said, it's what got President Trump to blink was that 10-year. It's a 10-year going over 4.5. I got to always remember which one it is and where it goes. And it is, it's been a wild ride, but it has largely, I want to say, recovered. It's back at 4215. Truthfully, Trump wants it lower. He wants it sub 4. He wants it as low as possible, right? Because that's what they pay on their debt. So he wants to get that number absolutely as low as possible. There's a ways to go, but it is moving in that right direction, and in that regard, certainly helping him. So it has been, as I say, if you, and everyone's saying this is not new for me, but if you'd gone to sleep on the 1st of January, if you'd had a big New Year's Eve party and you woke up 6 months later, i.e. you woke up this morning feeling refreshed from your big New Year's Eve party, you would look at markets and think, whoa, this is excellent. This is lovely. I am loving it. And that doesn't even tell part of the story. It's been crazy volatile. And there are some obvious lessons here. The first is, remember that volatility in markets is a feature, not a bug. Remember, don't panic. Use sell-offs as opportunities. It's like when Woolies has a sale on Chuckles. I go and buy Chuckles because I like them, and now they're cheaper than they usually are. And that politicians will typically open their mouth to either change feet or lie. They're the same the world over. There's absolutely no difference there. So, if you're an old hand at the market, you're saying, yeah, Simon, I know this. And you absolutely do. And sometimes we need to remind ourselves of that. But I get your point. If you are a new hand to market, you might be a little more spooked by it and kind of thinking, this is not quite what you signed up for. I want to have a look at the dollar index because this is a fundamentally amazing chart. So when are we? Back then, so January of this year, 110 is the dollar index. It is now 96.5. It is falling. If we look at USD Euro, because that really, the dollar index is mostly dollar euro more than anything else. That is at levels, and I'm going to have to zoom out a whole lot. We're back at levels last seen in 2021. Some folks want this the other way around, Euro USD, whichever. And the point being is, beginning of the year, sitting at 97 and change, now sitting at 84 and change. That is telling you the story perhaps more than anything. Money exiting the US and looking for a new home. Some of that new home has been into our market, thank you kindly. Some of it's been into Asia, some of it's been into other EMs, a lot of it is also going into Europe, and I don't see this changing anytime soon. What we've got in the US scenario is that essentially Trump has played his cards and realized he doesn't really have many cards. So he's sitting at 10% tariffs. That is making them money. It absolutely is. I'm at the beach next week, so I'm going to do a timeless podcast, which I will record sometime in the next couple of days around Trump's thinking. There is a plan behind what he says. We can debate whether it's a good plan. We can debate whether it's a viable plan, but there is a plan. Make no mistake around that. And his tariffs are netting them $20 or $30 billion a month. That's not bad. That's call it $1/3 billion a year. $1/3 trillion. That's real cash. But it's also turned away his allies. And I spoke about that early in the year, January, February. Decades of trust, decades of soft power have just been absolutely eroded. I mean, Canada, the largest unguarded land border in the world. And to be clear, it's not guarded. There's still not troops sitting there. But Mark Carney's like, these people are not our friends. Absolutely not. And that's what he's done. He's made America isolationist. And what matters about that is that America was the exact opposite of that. They were globalists. They were absolutely globalists. They were happy to do deals with everyone, buy their oil wherever, sell to whoever, get their products made wherever it was cheapest and ship them to America and get the iPhones and whatever it was. And he's turned that on its head. And what we're seeing here is early days of that. There's a long way still to go. This is not over. I think maybe that's the bigger lesson, is that what we've seen so far, particularly around the dollar, it's not over. Worldwide markets powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest Forex rates. Thanks to Standard Bank, thanks to Shift for that. We will park it here this week. My name is Simon. As I said, I am off to the coast, but there will be a show next week. If you want to know what the ETFs are, top ETFs so far this year, I'll publish that Thursday, justonelap.com/ETFs. Until next week, look after yourself. If you can, look after somebody else as well. Cheers all.